5 seasonal patterns every trader should know. If you've been trading without understanding these, you're leaving money on the table. By the end of this video, you'll know exactly when the market tends to rise, when it tends to fall, and how to use these patterns to time your trades better. Let's dive in. Pattern number 1. The January effect. Every year, something interesting happens in January. Stocks tend to rally, especially small caps. Over the past 15 years, the S&P 500 has averaged a positive 1% return in January, with a win rate of 63% over the past 40 years. But here's what makes it powerful. Small cap stocks do even better. The Russell 2000 has historically outperformed large caps in January by a significant margin. Why does this happen? In December, investors sell losing positions for tax benefits. Then in January, fresh capital flows back into the market. New year allocations from pension funds and retirement accounts add even more buying pressure. It's like a reset button for the market every single year. Pattern number 2. Sell in May and go away. This is probably the most famous seasonal pattern in all of finance. The idea is simple. Sell your stocks in May, go on vacation, and come back in November. Historically, the market performed better from November through April than from May through October. And for decades, the data backed it up. But here's the thing. This pattern is dying. Over the last 10 years, May through October has actually averaged a higher monthly return than November through April, plus 1.1% per month versus plus 0.9%. The summer months are now winning. May itself has been positive in 11 out of the last 15 years, with a 73% win rate. And July? July has averaged plus 2.8% over the last 15 years with an 87% win rate. That's the strongest month on the calendar. So what happened? Markets have changed. Algorithmic trading doesn't take summer vacations. Retail investors trade from their phones year-round. The structural reasons that made sell in May work, lower summer volume and institutional absence, simply don't apply the same way anymore. The only summer month that still consistently underperforms is September. We'll get to that one in a moment. But the bottom line is this. If you're still selling in May and going away, you've been leaving money on the table for the last decade. Pattern number 3. The Santa Claus Rally. The last 5 trading days of December plus the first 2 trading days of January. This short window has produced positive returns about 75% of the time historically, with an average gain of over 1%. That's a significant move for just 7 trading days. What drives it? Holiday optimism, low trading volume, which makes it easier for prices to move up, tax loss selling is already done, and institutional window dressing, where fund managers buy winning stocks to make their year-end reports look better. There's even an old Wall Street saying, if Santa Claus should fail to call, bears may come to Broad and Wall. Meaning, if the rally doesn't happen, it could signal trouble ahead for the market. Pattern number 4. The Halloween strategy. This one is the flip side of sell in May. Instead of selling in May, you buy on Halloween, October 31st, and hold through April 30th. Historically, this captured the strongest 6-month window of the year. November and December alone have win rates above 70%. Academic research confirmed this pattern across 37 different country stock markets, not just the United States. But remember what we said about sell in May? The gap is closing. Over the last 10 years, the advantage of November through April over May through October has nearly disappeared. So does the Halloween strategy still work? Partially. November remains one of the best months, averaging plus 2.8% over the last 15 years. October often delivers strong rebounds after the September weakness. So buying in late October and holding through year-end still has an edge. But the idea that you should be out of the market from May to October? That part no longer holds. The smarter approach today is to stay invested year-round, but increase your position size during the months with the strongest historical edge, like November, July, and April, while being more defensive in September. Pattern number 5. The September curse. If there's one month traders fear, it's September. Over the past 40 years, September is the only month with a negative average return. Negative 0.9%, with a win rate of just 46%. Over the last 15 years, it's even worse. Negative 1.3% average, with only a 47% win rate. September has given us some of the worst market crashes in history. The 2008 financial crisis accelerated in September. The 2001 terror attacks happened in September. Even in 2022, September saw the S&P 500 drop over 9%. Why is September so bad? Mutual funds have fiscal years ending in October, so they sell losers in September. Summer vacation ends and traders return to reevaluate their positions. And there's a self-fulfilling prophecy element. Because everyone knows September is bad, defensive positioning adds selling pressure. So how do you actually use these patterns? Here's the key insight. Don't trade seasonality blindly. Use it as a filter. When you're deciding whether to go long or short, check what the seasonal trend says. If the season supports your trade, you have an extra edge. If it doesn't, maybe wait for a better setup. And the best way to track all of this? That's exactly what SeasOptima was built for. Our platform shows you seasonal patterns for over 12,700 symbols, with detailed win rates, average returns, and interactive charts. You can see exactly which assets are entering their strongest or weakest seasonal periods right now. Visit SeasOptima.com and create your free account to get started. You'll get access to 5 symbols for free, including the S&P 500 in gold. In the next episode, we'll show you how to combine seasonal analysis with smart money concepts for the ultimate trading edge. Subscribe so you don't miss it. Thanks for watching, and happy trading.